Hello everybody, this is Leo Kelly and welcome to the first quarter Verdence Capital Advisors quarterly review. We're glad to have you with us today. Today we'll be going through several aspects of the economy and the markets. But first I wanted to start off by talking about a new format in our review. So my mother, in one of her critiques of the quarterly reviews, mentioned I might go on a little bit too long in one steady flow. So going forward, for your entertainment, what we're going to do is put in breaks in each section of this quarterly review. So as you'll see on the table of contents that we're going to show here, that there will be breaks for the economy, the stock market, the fixed income markets, and alternative investments. And that way, if you want to consume this data in one or two bites, this will make it nice and easy for you to get to one particular section. So with that, I hope you enjoy the new format. Let's dig into what's happening in the markets. So to begin our quarterly commentary, let's talk about the economy both in the United States and around the world. What's fascinating about the first quarter of this year, we have seen a continued and consistent global synchronized recovery across the world. Strength is showing up across the globe. As we'll see in our first chart, the green shows where PMIs are advancing. Now, what a PMI basically is a measure of the economic strength and the forward look of economic strength in any individual measured country or economy. Anything above 50 means expansion. Anything below 50 means contraction. So as we'll see, very few red dots here across the globe. It's green across the board, and that, of course, is contributing to this advancing economy and the steady growth in the economy, this acceleration in the economy around the world. So one of the questions we consistently get here in the first quarter is, does this expansion have room to run? That question is a very fair question given, as we'll see on this chart, we are in the second longest economic expansion in recent history. So we have to go back to 1991 through 2001 for an expansion that actually lasted longer. So 9.5 years into an expansion, can it continue? Well, the answer is yes. We're going to talk about the individual contributions to economic growth, but also it's important to take a step back. Now, what factors actually contribute to this expansion? Well, if we look at the main factors, first we see U.S. consumption. 70% of the United States economy is U.S. consumption. This is it, folks. This is the driver. This is going to make or break the economy. And as we'll see, the consumer is strong. The consumer is still moving forward. And most importantly, the consumer has put itself in a position to continue to have strength with its balance sheet. Manufacturing is starting to pick up. We're starting to see the symbols across different economic measurements that show us that manufacturing activity is getting stronger and stronger. Again, that helps, that brings in capital expenditures, that drives further growth, which leads us to the next factor, CapEx spending. Confidence leads to spending. And so when we look at factors like CEO confidence, small business confidence, consumer confidence, all of those continue to register at significant highs. So that is the precursor to additional CapEx spending. Again, green light looks interesting. Lack of excess, we just don't have inventory overhang. Inventory overhang tends to happen in slowdowns because manufacturing continues, inventory builds, people are expecting sales that don't come. Not the case right now. Right now, the economy is growing and accelerating, low inventories. Government stimulus, so that's been all over the news. We have a new spending bill. We're going to increase spending, and while that may create concerns about deficits, for now, for our purposes today and in the short run, spending is a part of that GDP growth, and that's only going to increase over the next year as the new spending bill starts to kick in. And finally, the central bank. So this is probably one of the areas that right now is causing the most concern. The central bank has started the process of contracting money supply, raising interest rates, but for now, we're still in a very accommodative Federal Reserve policy. So our view of this is we're not in a situation where that will start to pull back the economy. So let's dig into these factors individually and talk about the statistics that drive us to these opinions. So let's start with the U.S. consumer. So what we'll see on this first chart as we look back, really back decades in time, we look at the consumer's power to grow. And this measurement is their net worth as a percentage of their disposable income and their total net worth. So obviously over time, from back in the 40s to today, net worth has grown for the consumer. That's logical. The economy has grown, the country has grown, net worth grows, that makes sense. But the measurement of net worth as a percentage of their disposable income is the important statistic here. If our net worth is high, that breeds confidence, that gives us buying power, and the consumer is off into the economy. So we'll see in the chart, I think the specific data points that look interesting is consumer buying power was very, very high relative to disposable income in '99. We had a bear market, that pulled back, recession. Grew again into '07, booming economy, everything looked great, and then we had a stock market crash, pulled back in a recession. As we look today, the consumer is in the strongest position of net worth relative to disposable income that we've ever seen. So, check the box, consumer looks strong in this regard. So let's take a look then, what is the impact of all of this economic force on the markets? Well, looking at 2018's first quarter, we'll see that markets didn't exactly equal the strength of the economy. This is an important point. The economy doesn't necessarily drive the markets. The markets will move relative to their valuation and expectation. So we're going to break these markets down and show you why for the first quarter, while the economy continued to do well, we can see here markets were actually pretty mixed, flat to modestly down. As we look into individual sectors, almost every sector other than technology and consumer discretionary down for the quarter. If we look at bonds, interest rates, the Fed starts raising rates, bond prices are going down because bond yields are going higher. And so across this landscape in the first quarter, we have this disconnect. The markets aren't doing well, bonds aren't doing well, stocks aren't doing well, but what we're hearing is the economy is doing well. We're going to talk about that disconnect here in detail as we start to dig into individual valuations. So we've discussed the economy, the strength of the economy in the first quarter, and its disconnect to the financial markets. So let's break these down individually and look at valuations and why the markets are, in fact, disconnected. Let's start with the equity markets. I think the number one theme, if we go back to our 2018 year ahead view, we talked about the volatility, the sleeping giant of volatility returning to the market. We could check that box. Here it is in the first quarter, and volatility is back. This first chart shows the volatility index in the markets. And as we can see, volatility over the last year or so was extraordinarily low. In fact, record low. Kind of put the market to sleep. People started to expect that this is what equities do. They just go higher and higher and higher without any strain or stress on investors. Well, we know that's not true. Volatility in equities is in fact normal. What we saw last year is what is the aberration. And so here in 2018, we see this big jump up in volatility. And again, we're going to look at these numbers, but volatility is expected. And I would even say volatility is important as an investor. It gives us the opportunity to reprice assets back to fair valuation and give us the opportunity to buy assets at inexpensive prices. Now the challenge is it really inexpensive? So let's look at valuations and let's look at what volatility looks like. On this next chart, we talk about unwinding this abnormally low period of volatility. So the first chart shows the number of days the S&P 500 experiences a 1% move up or down. And so 2016, 2017, we saw these numbers start to drop off. This chart shows decades and decades of those numbers. Now, the interesting part is of this chart is 2018. 2016, 2017, very low numbers. Wake up every day and the market just goes higher. What's interesting about 2018, we're seeing these 200-point moves, 300-point moves, 400-point moves. In fact, 1,600-point moves. Volatility is here. But it's also important to take a step back. We are on track to have a slightly higher than normal 1% differential move per day relative to history. What I want to make sure that we take a step back and look at is the Dow Jones, when we look back to the low in 2008, 2009, was 6,600. Today, it's 25,000. So when we see a 200, 300, 400 point move, it's shocking. The press loves to make a big fuss about it, but the reality is, from a percentage standpoint, that's just a normal movement in a normal volatile market. So we don't want to get anybody stressed over the point number. We want to stay focused on the actual percentage move in the markets. So looking at drawdowns, which is the number from the top of a market down to whenever it makes a bottom in any correction or bear market, we'll see that in 2018, we are just now starting to come to the average drawdown in a recession. Well, of course, we're not in a recession. So why are we seeing this average drawdown if we're not in a recession? Well, the reality is valuation. And this next chart shows that the PEs in the market today are at a slightly elevated point. They are higher than the average PEs over time. This chart goes back to 1974. 1974 is an interesting date to start. 72, 73 was the Nifty 50. It was a big bull market. 74 starts a crash low. PEs in a crash low will be lower. So as we look at this full secular cycle of the market, we see that over different periods of time, valuations start to elevate above. When is a good time to buy? When valuations are low. So the fact that we're seeing a drawdown in the market today, probably more representative of the fact that valuations got a little extended in January. Everybody got excited. We ran up. More so that than there's a recession or the economy is starting to slow down. So we want to stay focused on valuations, and we want to stay focused on selectivity. What does that mean? There are pockets in the market that are less expensive than others, better opportunities than others. What we want to do is we want to go out and find those pockets of opportunity. So the first is value versus growth. Traditionally, value and growth will fight each other for the lead role, and we see these periods where they get to extremes. They start to get out 1 standard deviation, 2 standard deviations away. At 1 standard deviation away, we're interested. At 2, we have to take action. It doesn't happen often, but when it does, we want to move. And so these have happened at different points. When was the best times to buy value? Well, 1999, if we look at this chart on the left, one of the great times to buy value. Growth stocks were taking off. It was in the middle of the tech boom. What happened? It reversed, and good old-fashioned, what we used to call old economy stocks, took off. Great time to buy value. Remember, folks, buy low, sell high. You're always looking for those opportunities. When was another great time to buy value? 2009. And just recently, in 2015, third quarter going into 16, we hit one of those 2 standard deviation spreads. And look at this jump up in value stocks on the chart on the left. Where are we today? We're back down at almost the lowest point we've seen. And in fact, the lowest point since that 1999 extreme. So value over growth. And also we want to think about international versus U.S. The chart on the right shows the MSCI EFA, which is developed international markets, versus the S&P PEs. And what this shows is when the chart is high, international stocks are actually more expensive, and when it's low, they're cheaper. What we want to do is buy low. And so here we see international stocks as low as they've been since the crash. They had a nice run. Right now, the U.S. stocks over the last 2 years have had this fabulous run. And as we look at valuations, international stocks, specifically Europe, looks very inexpensive to U.S. So something to consider. Finally, when we look at the go global theme, we can see that as we look at a couple measurements, the S&P 500 return over the last 10 years minus the EFA, or developed international return, what this chart shows is, again, when the chart gets high, U.S. returns minus international returns are high. That means U.S. has had its run. It's time to start thinking about international. When this chart goes down, that means international is starting to get more and more expensive. It's had higher returns. Again, the chart is high. It's as high as it's been since 1998. this looks like an interesting time from a pure valuation standpoint to look at international markets. And lastly, relative to bonds, if we look at the dividends of stocks. Now here is a very interesting chart. The top chart is international stocks. It takes that, the Euro Stoxx 50, we said we like Europe, but it takes the dividend yield of that minus a German Bund. And the result is you get a yield higher than the bond of 2 to 4%. Okay, we know that German bonds are almost paying nothing, so European stocks look more attractive because of their dividend yield. Also, it's interesting on this chart, and an interesting valuation statistic is look at the orange line. So for the last several years, the U.S. S&P 500 stock market has been above the 10-year Treasury. It was paying you a premium in dividend to own stocks versus bonds. Well, just this year, that crossed down below the Treasury yield. So we have Treasury yields rising. Yields on the dividends of the S&P 500 are going down because price is going up. So the result is here we are in 2018, lo and behold, you're now getting paid more for a Treasury than for the U.S. stock market dividend. That's the first time we've seen that in a long, long time, several years. That's a valuation measure we want to pay attention to. So value still looks good in Europe because of a higher dividend. It looks good on a relative valuation. It looks good on relative prior returns. We'd stay focused in value versus growth, Europe versus U.S. And by the way, because of the tax cut here in the U.S., small cap looks to be a bigger gainer for the tax cut than does large cap. So we like small, we like international, and we definitely like value over growth. Similar to the equity markets, the fixed income markets have experienced more volatility than we've seen in recent years. And obviously, the first point or data point that the markets are looking at when they try to figure out why is fixed income going down, why is my bond portfolio, which has gone up pretty much consistently for 35 years, suddenly showing volatility? Well, the first answer is the Federal Reserve. As we look at the first chart, we'll see in the orange the history of the Federal Reserve's monetary policy, raising rates, lowering rates. And so we've had two bear markets here in 2000 and in 2008. And we see that the Federal Reserve is very aggressive in reducing rates. Now, traditionally what happens is the Fed reduces rates, stimulates the economy, and then puts the rates back to normal levels so the economy can run efficiently. Well, what's happened over the last several years is we've come out of the Great Recession. The economy has continued to grow 9 years now, but the Federal Reserve left monetary policy very accommodative. Well, this is absolute distortion in the marketplace. So as we can see, the Fed right now is playing catch up. It has to raise rates. It has to bring the rate level up to an acceptable rate that matches the growth of the economy. Why is this important? Because this is driving bond yields higher, which pushes down bond pricing. So the chart shows this step-by-step move, and we're hearing from the Fed they're going to keep doing this. So the question is, are we now in a tight monetary policy? Because historically, bear markets and really problematic bond markets happen when the Fed gets aggressive and takes us into a tightening policy. Well, our view on this is the Fed isn't necessarily tightening or hasn't become hawkish, they're normalizing. And that's the key word here. They are so far from where this should be that these moves are just bringing up the level of bonds to where they should be. So the obvious concern then is the Federal Reserve tightening? Are they becoming hawkish? Are they going to continue to raise rates to try to pull the economy back from an accelerated growth pattern? Why does the Fed do that? To stop inflation. Well, we don't necessarily see runaway inflation yet. It's starting to pick up, but it's not accelerating to the level where the Federal Reserve has to be aggressive. The word that's important on these charts is normalization. It's not being hawkish, it's not being aggressive. They've just been so overly accommodative for so long. Now's the time for them to bring rates up just to bring it back to normal. And in fact, if we look at the chart on the right, we're not nearly back to tight policy. As the chart shows that the real Fed funds rate is actually still below what we think the average has been and where they should be. One of our themes in the 2018 year ahead review was the unwind of the great bond bull market. Now, this bond bull market has been going on for 37 years. And for roughly the last 37 years, we have seen bond yields just go straight down. Well, again, yields go down, bond prices go up, they become more valuable. The reverse is true. And so what we're seeing in 2018 is a very important pivot moment where bond yields have broken out of that 37-year trend. The 10-year Treasury has broken through. It's touched or gotten close to 3% a couple times. It continues to pull back and go back and forth. Our view is that we are beginning the process of unwinding this great bull market in bonds and beginning the next wave, which we believe is going to be a secular bear market in bonds, where yields will go higher consistently over time. The economy sets up well for that. The Fed sets up well for that. Inflation sets up well for that. So as we look at the chart on the left, we'll see that the 10-year Treasury actually hit a price it saw not for 4 years. We think it's going to break out of the threes, and we think we're going to see higher yields. And that means we have to be very careful in our bond portfolios, because if we own long bonds and these yields continue to go up, the value of our bonds go down very, very quickly. As we look at weakness in the broad-based markets, what it shows us is, on the right, is in 2018, the Barclays aggregate year-to-date return was negative. The Barclays aggregate is kind of all bonds. It's corporates, it's governments, it's longer durations. Not a good year for the Barclays, and one of the worst years since 1996. So the bond market right now, which has been a place to just put money and go to sleep, it always works, is suddenly starting to become challenging and is going to require a more thoughtful process in allocating funds. Also, we don't want to be in the wrong place at the wrong time. As we discussed earlier in the economics section, the government is starting to spend more. We have this new spending bill. We're going to spend more. The economy is going to be driven more by government spending than it has been in the last couple of years. Well, as we know, the United States doesn't have the money to spend. That means they have to go out and they have to borrow it. And as we look over the last couple of years with sequester and paying down in low interest rates, we've seen that in 2014, 2015, the amount of money the government was borrowing was coming down. Well, that's reversing. And over the next few years, in 2018, 19, 20, we expect borrowing to go up significantly. Well, this is important, because if we have too much supply and not enough buyers, what happens to price? And in this case, price is yield. Yield has to go higher. You need to draw buyers to the market to consume all of this supply. Yields go up, bond prices go down. So this is another factor on top of the others that we've mentioned that causes us concern in bond portfolios. So what do? We play defense. The answer is, when a bond market is turning in the manner in which this is, you start to play defense. Well, there's a couple ways to do that. As we said, short bonds are safer than long bonds. There's less volatility and there's less downturn in a rising interest rate market. So our portfolios have to remain short and they have to remain safe. What also can be a big benefit is if we can get floating rates. So part of our allocation in our portfolios is corporate floating rate bonds. They're high quality credits, but the important aspect of this bond is the interest rate actually floats with the market. Suddenly I take interest rate risk out of the picture if my interest rate goes up with interest rates. And so that floating rate becomes a great risk aversion in a rising interest rate market. Floating rate notes how they outperform during rising interest rate periods. So here's several periods where rates actually started to rise, and we'll see 10-year Treasury performance was actually quite poor, averaging down 7.7 for all of these different periods. The Barclays aggregate, because it had high yields and because it had one particular year in 08 through 10, which was a recovery of the high yield market, did well. Pull that out, and the Barclays does not do well. Look at floating rates, consistently good in rising interest rate markets. So our defensive posture today is we want to make sure we're short. We'd love to have more floating rates. And on this next chart, we also want to be very careful with credit quality. High yield bonds traditionally will trade based on economic expectation. Well, today, economic expectation is that things are good. And so therefore, the price of high yield bonds is high. There's a low expectation of defaults. there's something called a spread. This chart shows the spread between high yield bonds and treasuries. That's the difference in the rate of return between a high yield or junk bond and a treasury. I want to go back and I want to remind us, we want to buy low and sell high. So what this chart shows is when the chart is high, that means spreads are wide, people are worried. When people are worried, price is crashing and the spread goes high. One of the greatest times in history to buy high yield bonds was back in 2008. The spread to treasuries, 18%. That means a treasury is paying 2% and a high yield bond was paying 20% interest rates. And the reason is because everybody was panicked. They thought the world was coming to an end. So what happened? They bought these 20% bonds. The markets corrected. Those spreads came all the way back to about 5%, and the price of those bonds skyrocketed. So when the spreads are high, prices are cheap. Where are we today? We're at about 3%. We're at one of the lowest levels we've seen in decades. That means prices are high. Put simply, do you want to take on the risk of a junk bond for a mere 3% more than a treasury? It just doesn't seem worth it to us. So again, we're going to play defense and we're going to stay with the higher credit qualities, and we'll wait for a better pricing opportunity to go back into high yield. So we reviewed the equity markets. We have volatility back. Valuations are slightly elevated. We've looked at the fixed income markets. Again, we're not getting paid for taking credit risk. We want to stay short. We want to stay defensive. So obviously the big question is, what do we do with our money? Well, obviously we're selective in our equities. We're defensive in our fixed income. Where is the opportunity in a market with volatility like this? And the answer is alternative investments. Over the last several years, alternative investments have really been pushed aside. And that makes sense. When the stock market's running, everybody just wants to get long into stocks and ride that wave. Again, buy low, sell high are a consistent theme. What happens in hot markets, the money runs to the market late just as the market's ready to turn over. Now, we're not saying that's going to happen this week or this month or even this year. But now's the time to start positioning the portfolio for more volatility, more equity, and more events. And the way you do that is hedge. Put it in an asset that's not correlated to the asset you own. That's alternative investments. If we go back in history and we look at years like 2002, in years like 2008, nobody wanted alternative investments. They were busy buying stocks in a hot market. When did they want those alternative investments? They wanted them in 2004, they wanted them in 2003, they wanted them in 2009 and 2010 after the market crashed, and they looked back and said, wow, these things protected portfolios. I wish I had them, I'll buy them now. So our advice is, let's look at them now, today, rather than look back and say, I wish I had. Traditionally, your diversified portfolio, the 60-40 stocks and bonds or 50-50 stocks and bonds, is built around the concept that when stocks go down, bonds do well. When bonds go down, stocks do well. So let's diversify. Well, the question today is, are bonds really a hedge for stocks? And this chart shows that over the years, when we see these big movements in the stock market down, bonds actually do quite well. Take a look at the 2000 bear market. Take a look at the 2008 bear market, and you'll see bonds are up when we see these big dips in stocks. But this time, is that going to hold? And in the first quarter of this year, thus far it has not. Stocks were down and bonds were down. So what we have to bring back into the equation is a 37-year bull market in bonds is reversing. There are so many people who have never invested in a bond bear market, a secular bond bear market. And so if this is going to start, can we definitely rely on the fixed income? Our answer is we don't think so. So what do? Well, the term hedging a portfolio is the genesis of the term a hedge fund. And so bringing in hedge funds to a portfolio, in fact, lowers the volatility and enhances returns over just a stock and bond portfolio. Let's take a look at this chart. So as we look at the chart and we see the orange-yellow line is equity, the red line is your traditional 60-40 stock and bond, and that black line is 60-15 bond and 25% in hedge funds. And let's look at the result here. There's actually only 2 points in time since 1989 where 100% equities beats our hedge fund, fixed income, and stock portfolio. Now, this goes against what everybody believes. Just put it in stocks and go to sleep and don't sell it and you'll be fine. Well, that only actually holds true at the very top of a bull market. And in fact, as we look in 2000, the top of the tech bubble, equities just got above this blended portfolio, and they're today just getting above. The rest of the time, because these portfolios hold up so well in downturns and still give us upside in normal markets, in fact, it runs right in parallel with the equity markets. It spends most of its time above 100% equity portfolio. But the key here is it does it with less risk and less volatility. So when is a good time to buy hedge funds? When markets are high. When that orange line gets above, that means hedge funds are at attractive prices. So we have always been a proponent of hedging strategies. Right now, it looks particularly important to make sure we have those in your portfolio. Additionally, another way to hedge a portfolio is to take out the market volatility. One of the challenges of investing in public equity is you constantly have this day by day, minute by minute, nanosecond by nanosecond movement in price. And we're already starting to see it. We just wrote a white paper here about a month ago on algorithmic trading and these shock events that happen in the market that you're looking at the market, it's down 200, and then you blink your eye and it's down 1,600. So these events are only going to increase with frequency as more and more speed trading comes into the market, algorithmic, computer-driven trading. And so what do? Well, one thing we can do is take our money out of the market. Private equity, another form of alternative investments, to us looks very attractive. Historically, private equity delivers higher returns than the stock market with lower volatility because it's not in the public markets. Now, this isn't for everyone, mainly because private equity is also illiquid. We have to put money in that we can lock up for years, 5 years, 7 years, 10 years. And so what we demand is an illiquidity premium of return. We want a higher return, we want lower volatility. It's not less risk, it's just less movement. So looking today and saying, is now an interesting time to buy private equity? Let's look at valuations. This chart shows since 2011, the valuation for the US public markets, the US private markets, and then also Europe's public and private. Well, as we'll see in 2011, the valuations were pretty close. Fast forward to today, and what we'll see is the US market, here's that stock run. Look at the valuations. They've jumped, and private equity has stayed relatively consistent on a valuation basis. As we look at Europe, that's also stayed relatively consistent on the private side, but the public side has now jumped up, and the public valuations are slightly higher than private. So going back to our themes, find better valuation. That's in the private markets. That gives us diversification, it gives us return potential, and it lowers the equity market volatility in our portfolio. Additionally, we're looking for hedges for income. We still want to generate income in a portfolio. So if in our fixed income portfolio, we're being defensive and we're pulling back and we're not taking the risk to grab a couple extra points for high yield or get a couple extra percentage points for a 20-year bond versus a 2-year bond, well, we have to find income somewhere. Again, let's go to the private equity markets. There are private equity ventures that strictly deal in debt. And they get payments, they get income and interest payments just like other forms of debt, but they go into markets that are not normally the purview of the public markets. And so as we look at this chart, we'll see the bottom chart, the bottom line is the 10-year Treasury, and the blue line is high yield, and then the top is what's called second lien debt. So these are somewhat more aggressive debts. They are not in the public eye, but they pay very high rates of return. And so that's that illiquidity premium. If we look at the gap between the blue line and the gray, that's the illiquidity premium. Now, as we'll see in 2008, when the markets crashed, these numbers went through the roof just as high yield did. The difference is they weren't marked to the market every second of every day. So when we look at opportunities for income, if we can find managers that do this every day, that know their private credit markets, and can give us a high-quality portfolio with an illiquidity premium on interest rates, that's definitely something we want to put a piece of our portfolio in. Now, like everything else, you can't overdo any one thing. no matter how high the potential rate of return is or how big the illiquidity premium is, this is illiquid. We want to put the right amount of money in these different endeavors, but we also think these are attractive diversification vehicles that will enhance our return over time. So in conclusion, as we look at the details of the quarterly commentary, and just to review, the economy seems to continue to grow at an accelerating pace, and so we are still positive on the economic outlook. The markets are volatile. We think they're going to continue to be volatile. We think this is a return to normal as opposed to what we experienced last year, which was the aberration. We're going to look for opportunities to invest money in undervalued sections whenever we see those and whenever we get a pullback in the market. Stay defensive on fixed income. We definitely want to take advantage of the alternative investment market, both on the private equity and the hedge fund side, to balance the risk in the portfolios and try to enhance our risk-adjusted returns. So with that, thank you very much for your time. I hope this was helpful. And as always, if you have any questions, please don't hesitate. Pick up the phone, call us. We're happy to go over any of the material that's contained in the commentary or any other questions you have. Thank you very much and have a wonderful, wonderful quarter. And finally, let's have a nice spring.